Coming up on the SBS on the Money podcast, inflation eases to even further into the RBA's target band. What does it mean for interest rates? And Virgin Australia, second day on the boards of the ASX, and another good day. We'll have all the details next. Hi everyone, it is Wednesday the 25th of June 2025. It's a day where the Australian share market didn't do much. The S&P ASX 200 pretty much flat, up just 0.04%, 8,559. We'll have the details though with Michael McCarthy from Moomoo in a few moments, including what he's telling his clients. But we'll start off with inflation because the monthly inflation indicator by the Bureau of Statistics pointed to an easing in consumer prices with the headline rate at 2.1%. That is at the bottom end of the RBA's 2 to 3% target band. And the underlying rate, which strips out one-off and variable moves to give a clearer indication of inflation and is the RBA's preferred measure, also eased further into that band. It's prompted economists at the Commonwealth Bank to bring forward their official interest rate cut expectations to next month with a follow-up cut in August. And it also followed weaker GDP, business and consumer sentiment data along with a steady labour market. And a breakdown of today's numbers shows that government subsidies have continued to keep electricity costs down, off by 5.9% over the year, while rents are now rising at their slowest annual pace since December, but are still high at 4.5% over the 12 months to May. Insurance, which peaked at an annual rate of 16.5%, has also eased to 3.1%, while lower global oil prices contributed to cheaper petrol over the year, down 10%. But some items are still rising faster than inflation, and the thing is, many are essentials. So food, for example, up 2.9% over the year, driven by chocolate, coffee and eggs. Eggs, incidentally, up nearly 20% over the past 12 months. Education and health are also higher. So for more on those numbers, including what it means for the Reserve Bank, I spoke with Harry Murphy-Cruz. He's the head of economic research and global trade at Oxford Economics. Harry, how would you describe the inflationary environment at the moment?
Well, I suppose we've spent the last 3.5 years almost exclusively worried about inflation. It's been the number one priority. But I think we're almost at a point now where we can say that the RBA has won that fight against inflation. We've got all the measures that the RBA really care about, being underlying inflation and headline inflation to a slightly lesser extent. They're back within the target band and they continue to move in the right direction. So really, I think the economy is moving into a slightly different phase, one where we're focused on taming inflation, now moving into something where we're really trying to support growth.
So that headline inflation rate, even though it's an indicator, right? So that indicator is at 2.1% annually through to May. We are still seeing some inflationary pressures though, like food, for example, it's above inflation at about 2.8%. There are some foods, eggs up 19%. Some of the basics are still elevated in some areas. Can you run us through those kind of pressures?
Oh, for sure. And so while those top line figures do look pretty good, under the hood, as you mentioned, there is quite a lot of disparity. And we're seeing above inflation increases for things like food, but also for other essential goods and services, things like education, healthcare, insurance as well. And the real difficulty with that is, these target lower income households more so, or they impact lower income households more because those households spend more of their incomes on these essential items. So we are really seeing pain in those types of cohorts. I think the question though is, how do we address that? And it's probably more of a task for government. They have much more targeted avenues to be able to impact and support households. Whereas the RBA, they very much have a blunt tool. And while we have those disparities under that top line figure, I don't think it should be enough for the RBA not to start moving into that sort of cutting and easing phase and supporting growth through the back end of this year.
You mentioned on other areas, the flip side, we are seeing some easing or even deflation in some areas. Can you run us through where we're seeing those easing of costs? Because some of them, again, are being supported by government subsidies, right?
Definitely. So the subsidies, they're really helping around electricity. We had oil prices drop as well, and that gave that headline figure a bit of an extra pull down. Obviously, with everything happening in the Middle East, we can't rely on oil prices going forward. Even though some of those essential goods and services that I spoke about are rising above headline inflation, they are still moving in the right direction as well, and that's helping broader services come down. Services have been very sticky over the last little while. We're now seeing that sort of catch up a little bit with the improvement that we've seen in goods overall.
You mentioned the Middle East, and on that theme of international US trade policy, are there any signs that Donald Trump's trade policies are impacting inflation at the moment? Because didn't the RBA say a few months ago that that trade effects would likely be deflationary instead of inflationary?
Yeah, definitely. So the RBA has done some great modeling on this. We've done some as well that says broadly the same story. Tariffs, they're inflationary for the US. Mathematically, when you add a tax onto something, things become more expensive and prices rise more quickly. But outside of the US, it's much more of a demand story. Tariffs hurt the global economy. That means that there is less being demanded. And so inflation overall is going to be lower. For Australia, that avenue really comes from China. So China is in President Trump's sights. Weaker growth there means less demand for things like iron ore, less demand for things like coal. And so Australia's economy is weaker through those sort of secondary channels. And that can be deflationary rather than inflationary.
And is it too early to tell whether or not that there's any impact at the moment?
Yeah, we haven't seen too much in terms of the hard data. I think the main impact at the moment is through those confidence measures. Household confidence, very, very weak. Businesses, particularly weak as well, because they're looking overseas and going, well, I don't know what future market I'm going to be able to sell into. I don't know what that is going to look like. And so many are sitting on their hands and really just waiting to see what happens.
Okay, so what do you think this all means for the Reserve Bank when it comes to meet to discuss interest rates? I note that economists at the Commonwealth Bank today have brought forward their expectations for a rate cut now to July and again in August. What do you think?
I agree. I think we're very likely to see that rate cut come through in July. There's enough in the data to suggest that it's warranted. It would be a little bit of a break from recent history. Look back at the previous two cuts this year. The RBA has waited to get that big quarterly measure of inflation, the things that tells them almost everything that's happening with prices. That's been warranted in the past, but I think now there is a body of evidence to suggest that inflation is under control, and there's no need to wait to confirm that with the next quarterly measure, which won't come until after that July meeting. So I think the July cut is certainly in play. We then expect probably one more cut towards the back end of this year.
That's Harry Murphy-Cruz there from Oxford Economics. Now, Market Day on the SBS On The Money podcast. Well, it appears investors are keeping calm heads following the situation in the Middle East because the S&P ASX 200 was pretty much steady today at 0.04% higher, 8,559. Materials sector, the worst performer, financials the best. In fact, the Commonwealth Bank hit another record high today, closing 1.7% firmer. The bank's doing well. Of those seeing a bit of a sell-off, Fortescue down 2.3%, BHP off 1.5% today, Rio Tinto losing 1%. Virgin Australia, which debuted on the ASX yesterday, rising 11.4%, gained another 3.4% today. So with all of the day's market action, I spoke with Michael McCarthy, CEO at Moomoo.
We've been flip-flopping around square for most of the day as a share market today, and the reason for that was we got first bite at the cherry. We had the news over the weekend that the US had made a decisive move in the Middle East, and it looked like de-escalation was on the card. So yesterday, investors piled into the Australian market, but today, even though we've got positive leads, they've already bought the news, and so there's not a balance of buyers to take us higher in trading today.
Still, given that, so while the market rose yesterday, it fell on Monday, but not dramatically, not following those attacks on Iran. What do you think that says about the way investors are feeling at the moment, since there's no major knee-jerk reaction to these types of events?
I think it reflects the fact that peace in the Middle East is not a market positive, but removing the threat of war in the Middle East is. And that's the reaction that we've seen in the market. Now that the threat of war has been de-escalated, there's now a green light for investors to buy those shares they've been holding off in case there was a worsening situation.
Virgin Australia's IPO was successful yesterday, up 11%. It's risen again today. What are your thoughts?
Well, it's a tough call. The airline industry globally and locally is a very tough business. And it's not one that I personally would look to buy into, but it appears I'm in the minority here because Virgin shares, as you rightly point out, have performed strongly in the 2 days that they've traded. The gains that we saw today on top of yesterday's gains suggest that at least one factor, that is the household name factor, might be supporting Virgin shares. It appears a lot of Australian investors know Virgin's product. They might fly Virgin planes, and they're happy to buy Virgin shares on the strength of that experience.
And speaking of buying shares, the Commonwealth Bank, another day, another record, approaching $200 per share, right? If I spoke to a lot of analysts earlier in the year, back then they said it was expensive. What do you think now?
Well, this is the stock that's made me the second best investor in my house. The reality is this one just has positive momentum. We've gone well beyond any reasonable valuation for CBA shares. It is not trading on valuation, but it does appear a combination of factors that are continuing to support it. One, it's one of the best rated banks in the world at AAA. The gains we're seeing are also partly, I believe, driven by the fact that it is such a well-known business here in Australia, and it's also the largest stock in the index. So if any investors from overseas are buying the Australian market, they're buying a good chunk of CBA. And that combination of factors has seen CBA just keep running and running.
And finally, what are you telling your clients at the moment? And are there any opportunities for investors?
Well, there's certainly a lot of risks still very real in investment terms. We've got concerns overall about the outlook for growth, and there are a number of hotspots around the world where trouble, whether it's tariffs or war, could cause markets to derail. So there are still substantial risks, but it's also indisputable at the moment the momentum is positive. And so what we're speaking with clients about and what they're telling us is that while they're cautious, they're positive in their outlook and they're taking advantage of the gains in the market.
That is Michael McCarthy there, the CEO of Moomoo. That wraps up the podcast for this Wednesday. Don't forget to give it a review or a rating on Spotify and Apple Podcasts if you enjoy it, and to click subscribe. See you next time. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.